Hello, welcome to Geojit Spotlight. Welcome back to this learning series. In the last episode, we concluded by looking at bulk investments in mutual funds. And I explained that bulk investments in mutual funds can turn out to be profitable if the bulk investments are made at attractive valuations. And attractive valuations happen when the market is at the trough of a bearish phase, at the lowest point of a bearish phase. But in practical terms, if you look at the market from the practical perspective, one can find that it is impossible to time the market. It is impossible to call the trough of the market. So a broad parameter would be to look at the valuations in the market. If the PE ratio in the market is less than 15 or 12 or less than 12, then the valuations will be extremely attractive, and that would be ideal time to invest in bulk. But practically it would be very difficult to time the market. And therefore, we always say that for most investors, a systematic investment plan is the ideal route for investment. In SIP or systematic investment plan, the investor need not time the market. As I said, timing is difficult, extremely difficult, almost impossible. Therefore, it would be better to have a time-proof investment strategy. Systematic investment plan is a time-proof investment strategy. You can make the investment even when the valuations are very high, because if the valuations are high, then for some period valuations will be trending lower when the market corrects. And that will give opportunities for investors to accumulate units of mutual funds at lower prices. So SIP is the ideal route for investment for vast majority of investors. SIP is done over a medium to long-term horizon. Over a 4-year period, will never fail. Very, very rarely there is a possibility of SIPs over 4 years turning into losses. Very rarely it can happen, but it will last only for a brief period of time. So what are the advantages of systematic investment plans? As I said, systematic investment plans are investments made in mutual funds, particularly ideally in equity-based mutual funds and hybrid mutual funds. SIPs can be made in monthly installments, quarterly installments, even half-yearly installments. But the ideal route is monthly installments, monthly systematic investment plans, because most people get their incomes once in a month. So what are the advantages of systematic investment plans? Advantages of SIPs. I will summarize 4 important advantages. Number 1, SIPs can be started with a small amount of money, as low as rupees 500 a month. So that means even people with low incomes can start SIPs. Now, this has a social dimension also. So let me briefly explain the social dimensions of that. Now, we know that wealth is created in the modern days through the stock market. Stock market is the institution that creates wealth. And we have a society in which there is big inequality in the distribution of income and wealth. So one of the ways by which inequalities in the distribution of wealth can be reduced is to enable low-income people to participate in this wealth creation through the stock market. So if people with low income start making investments in the stock market through systematic investment plan, that will make economic growth more inclusive. So inclusive growth is a very desirable form of growth. So that is the social dimension. The second advantage of SIP is that it is very convenient. You can choose a particular date in a month and make instructions for debiting the amount from your bank account. So if you choose the date as 5th, for instance, on the 5th of every month, the amount will be debited from your account. So it is very, very convenient. Thirdly, there is the most important advantage of rupee cost advantage. What is rupee cost advantage? You know, the market moves in ups and downs. Market movement is never linear. It moves in ups and downs. So when there is a downward shift in the market, a downward trend in the market, the NAV, net asset value of the schemes will decline, and it will enable the investor to buy more units with the same amount of money. So when market declines, NAV declines, and therefore more units can be bought with the same amount of money. And then when the market starts going up, the NAV increases, and the benefit of this lower cost will be available to the investor. For example, during the last 45 days, from if we take the 1st of April to May 15th of 2023, I'm talking on May 16th. During the last 45 days, Nifty has appreciated by more than 1,400 points, more than 6%. So the 6% appreciation has come in 45 days. So for those SIP investors who had invested in January, February and March, when the market trended down, they got the more units at the same amount, and this rupee cost averaging, the average cost going down, will prove to be very, very beneficial when the market starts going up. So this is the third advantage of SIPs, rupee cost averaging. And the fourth, perhaps the most important advantage from the long-term perspective, is that SIPs, if done for the long term, will enable investors to create phenomenal wealth in the long run. We know the power of compounding. The power of compounding works like magic in the long run. That was why Einstein famously said that the power of compounding is the 8th wonder of the world. In mathematics, 12 is double of 6. But 12% return over a long period of time is not double of 6% return. It can be several multiples through the power of compounding. I will explain this with the help of an example. Two individuals, A and B, investing in SIPs. A started at age 30, started early at the age 30, and they decided to invest till his retirement at age 60. So that is an investment period of 30 years. B started investment at age 35 and decided to invest up to age 60. So 60 is the retirement age for both A and B. Both of them decided to invest 5,000 rupees a month. So A would have invested for 30 years. 30 years is from 30 years to 60 years. 30 years multiplied by 12 months is 360 months. And the amount is 5,000 rupees. So 360 into 5,000, the amount invested over this 30-year period would be 18 lakhs. B also invested 5,000 rupees a month. B started investing at age 35. So he will be investing for 25 years. 25 years into 12 months equals 300 months. The investment amount is 5,000. Therefore, the total amount of investment would be 300 months multiplied by 5,000 equals 15 lakhs. Now, what will happen at the age 60? Assuming that the return is 12%, many mutual funds have delivered more than 15% return during the last 15 years, 20 years, 25 years. We are taking a conservative return figure of 12%. 12% return would have given A redemption amount of rupees 176 lakhs or 1.76 crore at age 60, whereas B would have got a redemption amount of rupees 95 lakhs at age 60. B invested 15 lakhs, A invested 18 lakhs. So this is very important. The difference in the investment is only 3 lakhs, but the difference in the redemption proceeds is 81 lakhs. So this is the magic of the power of compounding. So to summarize, the important advantages of systematic investments plans are, number one, you can start with small amounts. Number two, it is very convenient. Thirdly, there is the advantage of rupee cost averaging. And fourthly, long-term SIPs enables investors to enjoy the massive wealth creation that will be created by this power of compounding in the long run. Thank you.